I love dividend investing because it allows me to buy quality dividend-paying companies at great prices, which will eventually allow me to one day live off of my dividend income. Some of the strongest dividend-paying companies in the world are what's called a dividend king. Dividend kings are companies that are members of the S&P 500 and have increased the amount they pay in dividends for over 50 consecutive years. These are typically stable companies that generate major free cash flow, which allows them to reward their shareholders in the form of dividends. While most of these companies typically have lower dividend yields, there are a few that have dividend yields as high as 4, 6, and even 8%. In this video, I'm going to be discussing and analyzing the 5 dividend kings that have the highest dividend yield. And the first company that we are going to look at is a dividend king with the highest dividend yield, and that is MO Altria Group, currently trading at $45.80. We can see year to date they're down about 4.52%. Now they took a huge dive down in June, putting them in the trading range of the low 40s. We can see they were as high as around $55 a share earlier this year, but their dividend yield is currently sitting at 7.91%. That is ridiculously high for a company that is also a dividend king. If we go ahead and jump over to our dividend history tab right here, we'll scroll down. We can see they've been increasing their dividends for 52 straight years. That is pretty unbelievable. Let's go ahead and look at this dividend history. We can see they started paying it out back in 1989 when they paid out about 3 cents a share, and you can see some pretty phenomenal dividend growth over that time. But let's go ahead and jump into my stock valuation spreadsheet to see if we can find the fair value for this company. If you haven't seen how this spreadsheet works before, if you come up here and plug in the stock ticker, you can see all of this data is going to automatically load in. So when I plug in MO, here's all of that data loading in. If you'd like to be able to download any of the spreadsheets using this video, you can head over to my Patreon page at the link in the description. But if we come over here and look at our moving averages, we can see 20 and 50-day moving averages are up, the 200-day moving average down about 6%. Now we're currently looking at a 200-day change. Let's go ahead and zoom out and say we want to look at a 500-day change. What you're going to see is we had a huge run up in 2021 and then a huge decline fairly recently. So 1 year return of about -5%, 2 year return of 4%. So the beta is fairly low. It's below 1, so you're not going to see a whole lot of volatility typically with this company. Institutional ownership at about 60.3%. But let's go ahead and jump into our first valuation model, which is going to be Graham's valuation model. And this is a valuation model invented by Benjamin Graham, one of Warren Buffett's mentors and the author of the greatest investing book of all time, The Intelligent Investor. And here's the formula he lays out for us to calculate intrinsic value. So the first thing we plug in is the earnings per share for MO right here, and then we apply our growth rate projection right here, and we also have to plug in the current yield of AAA corporate bonds. And once we plugged all this in, you can see we actually get a pretty low intrinsic value according to Graham's valuation, but we'll come back to why that is a little bit later. Let's go ahead and look at our discounted cash flow model. And essentially for our discounted cash flow models, we want to project a growth rate for the future free cash flows for this company. And for a huge dividend paying company, obviously you have to see growing free cash flow if they're going to be able to continue to pay out dividends and increase the amount they're going to pay out in dividends. So this is very important. But after doing some research on the company and looking at industry expectations and analyst expectations, I'm applying a growth rate of about 5% to the future free cash flows and to the terminal value, which is the sum of the future free cash flows past the year 2030. I then took the present value of those future free cash flows and added them together here, added MO's cash and cash equivalents, and subtracted their total debt to get their equity value. I divided by the shares outstanding to get a discounted cash flow price per share of $67.36. Now let's go ahead and look at our multiples valuation model. Now this is kind of an interesting scenario, but the idea behind the multiples valuation model is we should be able to value a company by seeing how the market is valuing companies that are similar in structure using a price to earnings multiple. So we're taking companies that are similar to MO, taking the stock price and dividing by the earnings per share to get the price to earnings multiple. We then take the average price to earnings multiple of these companies, which we can see is about 14.57, and we multiply by MO's earnings per share, and this gives us our intrinsic value. So again, we get a really low intrinsic value according to our multiples valuation. Again, we're gonna come back to that in just a minute, but let's go ahead and look at our dividend discount model. Obviously a really important valuation model since many people are in this company solely for the dividend. But what we're doing is we're seeing how much they've been paying out quarterly so we can see their dividend growth over time and how much they're paying out in dividends. And we can see the year-over-year growth rate on average over the past few years has been about 6.58%. So that is pretty solid dividend growth. We can see they had a really good year right here of 14.29% growth. So that's pretty phenomenal. Going forward, I'm projecting a growth rate of about 5.5%. After applying a discount rate of 9%, we get a dividend discount model price per share of $108 per share. That is a lot higher than the current price. So if we jump over to our output output tab, we can see our valuations for this company are kind of all over the place. And so why is that? Well, it's important to understand each of these valuation models and how they work. So if we look at Graham's valuation, we can see this is a valuation model focused on mainly two things, maybe three: the earnings per share of the company and our growth rate projection. Now, obviously, the current yield of AAA corporate bonds is a little bit higher than it has been in the past. Earlier this year, it was as low as 2.8, but even if we move it to 2.8, we can see the intrinsic value is still sitting at about $19 a share. So with that being said, obviously the earnings per share for MO is a little bit lower than it has typically been in the past, which is going to drive the lower valuation for this. But since people are mainly focused in this company for the free cash flow and for the dividend payouts, really what we want to be looking at and making sure is they have a growing free cash flow and they have growing dividends. So when we jump to our output tab, I really don't think the multiples valuation is going to be a fair valuation, because this company is going to be trading at a premium due to the fact for how long they've been increasing dividends and how high that dividend yield is. So this probably doesn't provide a fair valuation because the company is going to be trading at a premium. So when we take our three averages of these valuations, we can see we come to an intrinsic value of about $63 per share. If we apply a 20% margin of safety, we can see our acceptable buy price would be about $50 a share, meaning this is a company we should buy at this point in time, since the current price is $45.08. Now, if you're a little bit of a safer investor and you apply a 30% margin of safety, we can see our acceptable buy price is $44.15, meaning this is a company that we should not be buying with our margin of safety applied. Now, a lot of people are worried about the safety of the dividend in this company, but if you look at the free cash flow, I think it's safe for now, and if they continue to grow the free cash flow at the rate that I'm projecting and analysts are projecting, this should be a dividend that is safe for quite some time. Let's go ahead and move on to the next company. And the next company that we are going to look at is Universal Corporation, stock ticker UVV, currently trading at $51.76, which gives it a dividend yield of 6%. Again, pretty high for a company that is a dividend king. Now, year to date, this is a company that's down 7.8%, which is better than the broader market as a whole. But let's go ahead and jump into our valuation. So again, we're going to go ahead and plug in the stock ticker up here, and all of this data will go ahead and load in. And one of the things you will notice, a little bit of a higher payout ratio, just like Altria Group, but you do have to keep in mind, for a lot of dividend kings, a higher payout ratio is going to be typical, but for the most part, the free cash flow should be able to cover this dividend yield. Now, moving forward, we are going to see that this company also has a beta of 0.57. Now, that is pretty low, so you're not going to see a whole lot of volatility with this company as well. But let's go ahead and move into our valuations. For Graham's valuation, after plugging in all of our variables, we'll go ahead and zoom in a little bit better. We can see they performed much better than Altria Group. Intrinsic value of $42.15. Now, the current price is $51.76, so that is a little bit lower than the current price. Let's go ahead and look at our discounted cash flow model. And you can see here, we did see a growing free cash flow, which is obviously a great sign for a company that we want to have the ability to continue to increase the amount they pay out in dividends. So I'm projecting a 4% growth rate for the future free cash flows. After plugging in all of our other variables, we can see I came to a discounted cash flow price per share of $55.75, just a little bit higher than the current trading price for this company. Now, moving to our multiples valuation, again, this is a company that is also in tobacco, just like Altria Group, so we have a lot of similar companies in this multiples valuation, including Altria Group. Now, obviously, just like we mentioned, Altria trades at a much higher price to earnings multiple for a few different reasons, but once we plug in all of these, we can see the intrinsic value for UVV, about $54.70, again, slightly higher than the current trading price. Moving on to our last valuation, the dividend discount model. Obviously, we all want to look at this. And one of the reasons that this company doesn't trade as high as of a price to earnings multiple as a company like Altria Group is when we look at this average growth rate over the past few years. Very low dividend growth. They do have a very high starting dividend yield, obviously at about 6%, but moving forward, I am projecting a growth rate of just about 1%. Now, after a discount rate of 8%, we come to a dividend discount model price per share of $45.59, a little bit lower than the current trading price. So obviously, with a high dividend yield, you're not going to typically see a very high growth rate for these companies. Now, moving to our output tab, after averaging all four of these valuations, we come to an intrinsic value of $49.55, which is very close to the current trading price. So if we apply a 20% margin of safety as a value dividend investor, we can see our acceptable buy price would be pretty close to $40 per share. But let's go ahead and move on to our next company. And the next dividend king that we are going to be looking at is LEG, currently trading at a price of $39.56, which gives it a dividend yield of right at 4.3%. Now, year to date, only down about 4.7%. So you're kind of noticing a trend. Most of these companies have outperformed the market year to date, only down slightly as compared to the S&P 500, down closer to 17, 18, or 19%. Now let's go ahead and jump into our first valuation. We'll come up here and we're going to plug in their stock ticker and hit enter, and we can see all this data is going to automatically load in. Now here you're going to see they have a payout ratio of 60%, so that is fairly safe when you consider the fact that they are a dividend king. But there are some macroeconomic risks with this company. You can see LEG is expected to generate $2.79 in earnings per share this year, while paying out an expected $1.71 dividend according to analyst expectations. Now if you look here, you can see if they were to suffer a drop due to macroeconomic trends, this dividend yield would not be very safe. But as for now, I think it is safe, but there are some macroeconomic risks that you do have to be made aware of. Now analysts currently have a price target of about $41 per share for this company, and the beta is a little bit higher, so you might see a little bit more volatility when you look at this company. But let's go ahead and look at our first valuation at Graham's valuation, and we will zoom in here. If we come here, we can see current intrinsic value for this company after plugging in all of our variables is $37.28. Pretty close to the current trading price. Let's go ahead and look at our discounted cash flow model. And again, we want to project a growth rate using the prior year's free cash flow and looking at industry and analyst expectations. After doing so, I decided to apply a growth rate of right at 5.5% to the future free cash flows. After finding the present value of these future free cash flows, I added them together, added the cash and the total debt to the company, and we can see the equity value listed right here. After dividing by the shares outstanding, we come to a discounted cash flow price per share of $37.84. Again, very close to the current price and very close to Graham's valuation. Now let's go ahead and look at our multiples valuation model. And there's only a couple companies that I did feel comfortable using as a comparison with the multiples valuation. But again, we're taking their stock price and dividing by the earnings per share to get our price to earnings multiple. Average PE was about 12. So after we multiplied by the earnings per share for LEG, we come to an intrinsic value of $34.21. Again, close to the current trading price, but slightly below. Now, if we go ahead and move on and look at our last valuation, which is going to be the dividend discount model, it's going to see how much the company pays out in dividends and how much their dividend is growing over time. So we can see average growth rate of 3.76 right here. Moving forward, I'm projecting a growth rate of about 4%. After applying a discount rate of 8%, we come to a dividend discount model price per share of $45.76. Now on our output tab, again, we'll see all four of our valuations. When we average them together, we come to an intrinsic value of $38.77, slightly below the current price of this company. Now, as a value dividend investor, again, always apply a margin of safety. Let's say I were to apply a 20 or let's say a 10% margin of safety. And we can see based on this, our acceptable buy price would be about $34.90. Now, if we apply a 20% margin of safety, we can see it would be $31.02. So you're kind of noticing a trend. A lot of these companies are already trading very close to their current price. That's because when we have times of, contractionary period in the markets, you're going to see a lot of these more stable dividend king companies. A lot more money is going to be poured into them, raising them and making them have a higher price to earnings multiple. So that's one of the reasons you're going to see a higher price to earnings multiple typically when we have a market downturn with the dividend kings. But let's go ahead and move on and look at our next company. And the fourth dividend king now we are going to be looking at is very popular among many types of dividend investors, and that's ABBV, currently trading at a price of $137.91 per share. Now, again, year to date, we can see they're actually up about 1.84%. So one of the rare stocks that has actually been in the green over this past year. Now, go ahead and jumping into our stock valuation spreadsheet, we'll go ahead and plug in their ticker and all of this data will automatically load in. We come over here, we can see they currently have a dividend yield of about 4.09%. So a pretty high dividend yield for a company that's been increasing dividends as long as they have. Payout ratio currently sitting at about 76.4%. So obviously a little bit higher than we like to see it, but not necessarily at risk when you consider the fact that the best way that this management can provide value to their shareholders is by paying out dividends. Now, moving forward, we can see we actually have this company's in the healthcare industry. This is the first company we've looked at that's a dividend king within the healthcare industry. Analysts currently have a price target of $159 per share, and again, a beta of 0.7, so you won't see a whole lot of volatility. But let's go ahead and glance at our valuation models. And again, the first one we will look at is Graham's valuation. If we come over here, we can see pretty strong earnings per share for this company, but they do have a very low growth rate projection. Now, after plugging in the current current yield of AAA corporate bonds, we can see we come to an intrinsic value of about $59.39 per share. But let's go ahead and jump over to our discounted cash flow model. And again, we want to project a growth rate to the future free cash flows for the company. So we do things like look at the historical free cash flow for the company, look at industry expectations and analyst expectations. And after doing that, I projected a growth rate of about 4% to the future free cash flows. I found the present value of those future free cash flows and added them together, added the cash and cash equivalents, subtracted the total debt to find the equity value, divided by the shares outstanding, and we can see pretty strong discounted cash flow price per share of close to $169 per share, much higher than the current price of $137 to $138. Now let's go ahead and move forward and look at our multiples valuation. I really like the multiples valuation for this company because I think we have a lot of great comparisons for this company. We're taking companies like J&J, MRK, LLY, and BMY, taking the stock price, dividing by the earnings per share to get the price to earnings multiple. We can see here the average price to earnings multiple for these companies is 28.19. So once we take this and multiply it by ABBV's earnings per share, we come to a stock price of $170 per share. Now jumping over to the stock screener, you can see anytime this is the case, it means they have a higher price to earnings or a really strong earnings per share, one of the two, which leads to the higher multiples valuation. Now let's go ahead and look at our last valuation, dividend discount model. The first thing you'll notice is we have really good dividend growth from this company. When you consider the fact the company has over a 4% dividend yield, they've been increasing dividends for a very long time. That makes it even more impressive they have such a high growth rate for their dividends. So moving forward, I'm projecting a growth rate of about 6.25%. After applying a discount rate of 9%, we come to a dividend discount model price per share of $217.91. Now jumping over to the output tab, we have all four of our valuations, and when we average them together, we come to an intrinsic value of $154. Now Graham's valuation is a little bit lower than the others. That's obviously because of the low growth rate projections. When you look at the discounted cash flow, you see the free cash flow growing, you see the dividends increasing on the dividend discount model, and a really strong multiples valuation. This leads to a really good intrinsic value. So as a value dividend investor, again, always apply a margin of safety to your investments. If we apply a 10% margin of safety, we can see based off of this, our acceptable buy price is $138, meaning this is a stock we should be buying because it's right at that acceptable buy price. Now, if you're a little bit safer with your investments, say you want to apply a 25% margin of safety, you can see your acceptable buy price will need to be about $115 per share. But let's go ahead and move forward and look at our last company. And the last dividend king that we are going to be looking at is 3M Company, currently trading at $141 per share, which gives them a dividend yield of close to 4.2%. Now, something that is a little bit different about this company is they have been declining in share price for quite some time now. If we come here year to date, we can see they're down a little bit over 20% over the past year, over 27.5%, and over the past 5 years, down over 30%. But let's go ahead and jump into our valuation models and see if that is fair. We'll come up here and plug in our stock ticker for 3M and hit enter. Come over here and look at the dividend data. Again, we can see dividend yield of close to 4.2%. Again, a higher payout ratio, but I don't think it's necessarily at risk. Moving averages, 20-day down, 50-day actually up a little bit, and the 200-day moving average down about 8%. This company is in industrials, and you can see analysts currently have a target price of about $147 per share, beta of very close to 1, so the volatility levels are going to be pretty close to that of the market. Now jumping into our first valuation, we're going to look at Graham's valuation. We'll come here and zoom in just a little bit. We can see earnings per share of about $7.15. I'm applying a growth rate of about 6%, which is what analysts are expecting. After plugging in our current yield on AAA corporate bonds, we come to an intrinsic value of about $97 per share. Let's go ahead and jump over to our discounted cash flow model. And after looking at the historical free cash flow for this company and looking at industry and analyst expectations, I'm projecting a growth rate of about 5% to the future free cash flows of the company. Obviously, I then took the present value of those future free cash flows and added them together, added cash and cash equivalents, and subtracted the total debt to find their equity value. After dividing by the number of shares outstanding, we come to a discounted cash flow price per share of $196. Now, when we look at the multiples valuation, you can see I actually didn't use this valuation model because I didn't feel that 3M had very good comparables for this valuation, which would lead to a faulty intrinsic value. So I decided not to use this model. But let's go ahead and jump over to our dividend discount model. And essentially, again, the idea behind this is to value a company based on how much they pay out in dividends and how much that dividend is increasing. So I plugged in the quarterly dividend payouts to see how much they've been paying out each year, and we can see the dividend growth year over year. So we had one year that was close to 6%, but other than that, it was a little bit lower, 2%, and then under 1% 8% over the past couple of years. Moving forward, I am projecting a growth rate of 3%. After applying our discount rate of 8%, we can come to a dividend discount model price of $122 per share. Now, if we jump over to our output tab, we can see all 4 of our valuations, didn't use the multiples, but when we average these 3 together, we come to an intrinsic value of $138, close to $139 per share. Very close to the current trading price. Now, in previous videos for 3M, I did have a little bit of a higher intrinsic value due to projecting slightly higher growth rates, but you can't talk about 3M stock without talking about the potential litigation that they are currently going through. And after diving into this a little bit more and having more information revealed in the past few weeks, we can see this is going to be a potentially very devastating lawsuit that they're going through. They're going to be paying out anywhere from 12 to 45 to even $78 billion. So that is going to be very harmful to the business in the short term, probably causing the current price to drop. So it's harder to apply a high growth rate to the dividend, knowing how much they're going to have to be paying out in cash in the near future. But still, regardless, I think this company has a high dividend yield, very close to its current trading price, but as a value dividend investor, again, we always want to apply a margin of safety. So let's say we apply a 20% margin of safety. Based off of this, our acceptable buy price is about $111, so this is not a stock we should be buying. But there you have it, guys. Those are the 5 companies that are dividend kings with very high dividend yields. Go ahead and let me know what you think of these companies in the comments down below. If you'd like to be able to download any of these spreadsheets using this video, then you can head over to my Patreon page at the link in the description. So that being said, thank you guys so much for watching. Please don't forget to leave a like and subscribe to the channel.